All right, we're going to give it a moment as people fill in here, and then we'll go ahead and get started. Yeah, I'm joining now. All right, another few seconds or so. All right, I'm sure people will continue to fill in over the next few minutes, but we'll go ahead and get started. So good afternoon, everyone, and thank you for joining us for today's webinar. We will be covering the tax impact of your business entity choice, and we are pleased to be joined by one of our tax experts, Glenn Schweier. Glenn is both a CPA and a licensed attorney in New York and New Jersey and has in-depth experience in the world of business and taxes and much, much more. So today, Glenn will discuss the tax implications of the different entity types and give insight on choosing the right entity for your business. So if you guys have any questions, you can submit them through the Q&A box, and we will reach out to those of you directly who have a question specific to your situation, and we can collect your information that way. Or you can always reach out to Glenn or I separately after this. So with that, I'd like to hand it over to Glenn to go ahead and get started.
Well, thank you everyone for joining us. I'm live from Mount Arlington, New Jersey, and I guess everybody else is around New Jersey or around the country. Thank you again for joining us. And let me just kind of go through the 1-minute presentation on the firm. I always like to tell people, in case most people or clients are familiar with the firm, but in case there's people out there who are not clients, I just like to give a 1-minute presentation on what the firm's about. You know, we offer auditing services, commercial audit, benefit plans, and then tax-exempt entities, nonprofits, and then our government side, which is about 1/3 of the practice, the school boards, municipalities, counties, and then, of course, we've got the tax department, which I'm in, which is businesses and individuals, estates, trusts, accountings, fiduciary accountings, and probably one of the biggest growing and biggest in demand services we offer that's growing is client accounting services, where we do people's bookkeeping and also CFO type services. Nisivoccia also has, through Nisivoccia Wealth Advisors, LLC, financial services. You know, they do for individuals, smaller individuals, larger individuals, retirement plans. And all told, the assets under management are probably about $1 billion or somewhere in that neighborhood. That's what they tell me, somewhere in the neighborhood of $1 billion. It seems kind of unreal to be that much money, but that's what the assets under management are through our NWA company. You know, I'm going to try to keep this as simple as possible and on a kind of a level that everybody can understand. You know, everything I'm going to talk about, there's probably an exception for it. So I'm not going to go into the crazy exceptions and debt-based rules, and I just want to give people a general idea of what type of entities are out there and why you might choose one over the other. Because I get this question all the time from clients as like, they're forming an entity, what type of entity should I form? And for some clients, one type of entity might make sense. For another client, a different type of entity might make sense. For tax purposes, there's essentially 4 different kind of entities. There's a sole proprietorship, which is deemed where you're owning the business and you're operating it either through a Schedule C that's reported on your 1040 or a Schedule E or some other form on the 1040 series, where your income and expenses and the actions of the entity are reported directly on your 1040. There's another type of entity, partnerships. I think most people have heard of these types of entities. And a partnership files its own tax return. There's 2 or more partners, and that's the second type of entity the IRS has. Then there's an S corporation, where you're a corporation, but we'll kind of go through the definition of this, but you're kind of a flow-through entity. And then there's the typical C corporation, which General Motors is, and IBM and Facebook and all these other companies. The large companies are almost always C corporations, and we'll talk about why that is as well. But that's the general type of entities that there are for people to kind of choose from. And they all have their pluses and minuses. There's other types of entities, trusts, nonprofits, different variations of those, but those really aren't used to operate an active business for the most part. Theoretically, trust could be a shareholder of certain types of businesses, co-owner of the business, but it's generally not how a business is operated. And one of the reasons why trust hits the highest tax bracket, around $14,451, they're at the 37% tax bracket. So they hit the highest bracket very quickly in terms of what they, the highest bracket. Individual doesn't hit the highest bracket to hundreds of thousands of dollars more than that. So therefore, the trust generally isn't how a person's going to operate directly. Sole proprietorship. Sole proprietorship is the entity where it's going to be reported directly on your 1040. Why is a lot of people use this? They're starting out a business. There's no formal creation of the entity. You just start operating from day one as a business, whether it's landscaping or delivering newspapers. That activity would be reported on your 1040 Schedule C. Or if you just buy a rental property and you buy the rental property in your own name, you start renting it, that's going to be reported on Schedule E. That's a sole proprietorship. You own the business directly. There's no entity protection, and that's getting reported directly on your 1040. Why do people do it? Easy. It's simplicity. It lowers operating expenses. You don't have a separate tax filing. The problem with it is there's no shield from personal liability, especially if you own a rental property. Rental property, someone slips and falls down the stairs, slips and falls on the sidewalk, and then they're suing you. You have no protection for your own individual assets. They could go after more than the property itself. So there's no liability protection. And it's usually, a sole proprietorship is generally going to be used when you first start a business, or probably the unsophisticated business is using that sole proprietorship. The next form of business, and this limited liability company, and we're going to talk about this, limited liability company can be multiple different types of business. And it depends on the number of members, and also depends on the number, certain elections that you make. But the IRS default rules is when you create a limited liability company with one owner, it's considered a disregarded entity for tax purposes. So it still gets reported on your 1040, but it's treated as if you own everything yourself. For tax purposes, it's treated as if you're basically a sole proprietorship. You're the sole owner of the entity, and it gets reported on your Schedule C or Schedule E, the rental property. And it's probably largely used for rental property, especially for small owners of rental properties, or they only own a couple of rental properties. And it provides limited liability protection. So if someone slips and falls, the most they can take is that property that's covered under the LLC. They can't go after your personal assets. As long as you keep your personal and business assets separately, you can lose that liability protection if you start intermingling things. So the advantage of the limited liability company, disregarded entity, liability protection, one layer tax, gets reported on your 1040. There's no separate tax return filing. You have to pay an annual report. Has low operating expenses. The other advantage of it, if you have no employees, there's no payroll. So we'll talk about this too. As a corporation, you have to have payroll. But for a sole proprietorship, limited liability company with one owner, there's no payroll. So you don't have the cost of paying paychecks or ADP, the cost of running payroll, which can be substantial and really adds up very quickly. The one downside of all these entities is that you have self-employment tax. So when you work for yourself, and this is where a lot of clients get in a lot of trouble, where they form an entity and they're thinking, hey, I'm subject to tax at my marginal rate, which is 24%. And they kind of anticipate when they file their tax return, that's what they're going to owe. The problem is when you're self-employed and you're active in the business, not a rental property, that's considered a passive activity, but an active business, a lawyer, doctor, self-employed person who's operating an active business, You're subject to self-employment tax, which are 15.3% of the first up to the Social Security max, which is about $150,000 these days. So, 15.3% on $150,000 of income adds up very quickly. And therefore, you have to anticipate it's almost another layer of tax. When you're getting a W-2, that's automatically withheld from your pay. When you're getting a W-2, Social Security, Medicare is already withheld from your pay. New Jersey taxes, federal taxes, other state taxes are withheld from your pay. But when you're working for yourself, the self-employment tax gets paid on your income tax return, your 1040. When you're working for yourself, you don't have that tax withholding. Therefore, you have to allocate those funds and pay estimated payments, which is another level of kind of complexity that when you first start your own business that you're not used to. So if you have significant income, self-employment tax and estimated payments are going to kick in, and you have to keep that in mind from $1 that you earned. Flow-through entities. Now, these give you the advantage of being taxed on your personal tax return, the income that it earns, but it requires another level of filing. So flow-through entities, that's your partnerships, your S corporations, those are flow-through entities. They report the business activity on the tax return of the entity, and then they issue a K-1, which you report the income and expenses on your tax return. And this is regardless if you're active in the business or passive. If you're an investor in the business, an S corp partnership, you're getting a K-1, which is reports the activity on your 1040. It's not reported directly, so you got another tax filing requirement when you do that. The advantage of a partnership. Now we're going to get specifically into partnership. Flow-through entity, you get a K-1, you have to file 1065. There's no wages for the partners. So kind of like a sole proprietorship, but now you've got more than one partner, more than one person involved in the business. You have multiple people involved in the business. So now, if it's only the partners, you still don't have to do payroll. So there's an advantage to that. There's also advantage also adds to calculation of retirement plan contributions and other kind of elements as well. But there's partnership, no payroll if you only have the partners. If you have employees, then you have to run payroll. Partners should not be getting W-2s. I've seen many cases where partners are getting W-2s. Technically, a partner, an equity owner of the business should not be getting a W-2. They should be getting a K-1 from the business for their share of the income. The advantage, now, if you're active in the partnership and you have self-employment income, same kind of situation is going to apply. You're going to have to make estimated payments. You're going to have to pay the self-employment tax on your 1040 income tax return. Partnership is not generally paying taxes for the most part. They could be subject to something called BAIT, New Jersey BAIT, or not, withholding. But for the most part, the activity of the partnership is getting reported on your 1040, but it's a flow through. K-1 is reported on your 1040, not the actual activity, the sales and gross receipts and expenses of the business itself. It's only the partner's share of that activity. Partnership means you have more than one owner. One of the advantages of a partnership is flexibility. Now, we'll talk about S corps later, but flexibility of the partnership is huge because you can allocate income pretty much any way you want as you put in the partnership agreement. There's tremendous flexibility in terms of you can give one partner, 75% of the income, the other partner 25% of the income, even though one partner's both 50-50 capital interest. You can do all kinds of agreements where you can kind of move income from one partner to another. But the downside of that is you have to file a separate tax return for the partnership itself. I just want to really quickly go through a couple of different types of partnership. There's a general partnership where basically you just decide you're working with someone. You either have a written agreement or just oral agreement, and you just decide you're working for someone. You didn't form any kind of entity. Therefore, you have no liability protection. It's still subject. IRS is going to basically treat it the same as a flow-through entity K-1 requirement, but you don't have any liability protection because you don't have an entity. And generally, the state rules would kick in if you don't really have an agreement, a formal agreement. The state has agreement default rules that kick in for partnerships. The second type of partnership you generally see is a limited partnership. This is where there's generally one general partner, at least one general partner. They have unlimited liability. And then there are passive investors who are the limited partners. So generally the passive investor, they contributed capital. They have liability protection. They can only lose the extent of their capital contribution, but they really can't be active in the business. You have a general partner. The general partner could be a corporation. It could be a partnership. It could be another entity. But that general partner has unlimited liability under the rules. Even if it's a corporation, the corporation has its own liability protection. The general partner technically has unlimited liability in a limited partnership. Limited liability partnership, which Nisivoccia is. This is basically similar to a general partnership, limited partnership, taxed the same way. But the limited partner, limited liability applies to all partners. So therefore, the limited liability, even if you're active in the business, you have limited liability. Now we get to limited liability corporation. I think this has probably become the most popular vehicle, especially for real estate investments and small businesses, is limited liability company. As I talked about, default rule is one member. You're a single member LLC, you're disregarded entity, it's reported on your 1040. If there's two members, the default rule is your partnership. Unless you make an election to be taxed as a corporation, then you might have to make another election to be taxed as an S corporation. But the general default rule is two members, your partnership. Advantage of this, limited liability company has tremendous flexibility. Some of the other entities have partnership entities have the general, they have liability, don't have liability protection, or there's only one general partner. Single member LLC can kind of form where you can really control who controls the limited liability company, who controls the partnership. And you can put that into the agreement. I think that's one of the reasons why it's kind of gotten tremendous popularity, because you can have a very flexible management structure where one partner is making all the decisions, or a group of people, and also has the partnership advantage of income allocation. You can choose how you allocate the income. It doesn't have to be deemed set structure. There can be guaranteed payments. There can be certain classes of income to certain partners. So there's tremendous flexibility, specifically with real estate. Real estate, it's in the LLC, slip and fall. All they can do is take the real estate of that property. You probably should have liability protection as well, but that's a different story. But it's tremendous flexibility, especially for the small real estate investor. And I just want to go back to one concept here. Tax basis. When you're a disregarded entity, excuse me, when you're a disregarded entity, LLC or sole proprietorship, you are the same person as the entity itself. So for tax purposes, the money that flows in and out, the way the IRS looks at it, it's your money. For partnerships, S corporations, specifically, the concept of tax basis is very important. The tax basis determines what money you can take out of the entity and what losses you can take without based on your tax basis. So if your income, you take a distribution of $100,000, you put only $50,000 into it, and then you took out another, you had $20,000 income, that $30,000 left over could be a capital gain. Could it be a distribution in excess of basis? The same thing, you put $100,000 into the company and you have losses of $140,000. You may not be limited in the amount of losses you can take up to $100,000, and the $40,000 additional losses might be trapped inside the entity as a losses in excess of basis. And until you restore that basis, you can't take those losses. So that's kind of the tax basis rules that you need to keep in mind. You can take your tax basis is what you contributed to the company, the income that it earns, then your distributions is your negative, and the losses are negative against the basis. That's kind of a very simplified look at it. Is basically if you have income of $50,000 one year, you probably can take $50,000 out of the business, all the income distribute out to the owners, and not be in excess of basis. But if you have $50,000 in the business, you probably can take $50,000 of losses, roughly. Now, the other side of this is you can increase your tax basis based on the income. Why is that? Because the income, and if you don't take distributions, why? Because income is a flow-through entity. So this is the downside of a partnership. It's a flow-through entity. So therefore, whether the income is distributed out to you, you are taxed on it. So the business earns $100,000 of income, distributes out to the partners nothing, you are still taxed on $100,000 of income. So you could be taxed on income that you never actually received, which is very problematic for clients to realize that they're being taxed on income on this flow through on their 1040 that they never actually receive. So most partnerships will make what we call tax distributions. Will make distributions of the actual earnings, or they'll make distributions enough to cover what they think is going to be the partner's taxes. But that's very important to understand as well. It's a flow-through entity. You pay tax on the income, you pick up the losses, whether something's distributed out to you or not. It's kind of like dividends. Dividends that are earned by the companies you invest in that are distributed out and they're just reinvested. You never touch them. They're still taxed. Same thing with a flow-through entity. The partnership earns income. It's never distributed out to you, but you still pay tax on it. Okay. S corporations. Now S corporation, first thing to remember is if you want to be an S corporation, you want to be a flow through, you want to be a corporation, but you want the income to flow through to the owners of the business, the shareholders of the business. You have to make an election. If you don't make that election, then you're going to be treated as a C corporation. Sometimes you can go back in time to make that election, a retroactive election, if you've treated the entity as an S corp election, but then you're kind of relying on the IRS to approve that. So the best action is to be an S corporation basically from the beginning. So you want to make that S corp election. Now, New Jersey always required a separate S election, but they have stopped that starting December 22nd, 2022. But there's still formalities, even though New Jersey doesn't require a separate S election, there's still formalities that New Jersey wants you to go through. They want the entity to be registered as a corporation. They want proof of the federal S election. They want you to submit shareholder jurisdictional consent. So there's still some hoops you got to go through. But New Jersey did stop the separate filing for entities after December 22nd, 2022. New entities formed after then. A separate New Jersey election is not required. Now, same thing as a partnership. S corporation's got to file its own tax returns, got to file 1120S, and the income comes out in the K1 to the shareholders. Same thing, same problem. The shareholders, the income can maybe not be distributed 1 year, but you're still picking it up in tax. Now, the problem with this, well, one other thing I was make sure I want to go through is distributions. Now, partnership, if you're active in the partnership, the distribution via the K1 is subject to self-employment tax. The advantage of the S corporation, that distributions from the S corporation are not subject to self-employment tax. It's a little loophole in the law, is that they're treated as basically distributions and not subject to self-employment tax. They've talked about correcting this issue, but they still have not at this point. Now, the other side of this is reasonable compensation. That's unlike partnership, sole proprietorship, S corporations have to pay their shareholders reasonable compensation. Now, the IRS would like the shareholder to be paid compensation even if it creates a loss for the entity. So say the entity had income of $50,000, reasonable compensation is $100,000, then the S corporation would have a loss of $50,000. The IRS looks at it, you should be paid reasonable compensation for the work you're doing. So if you're an attorney, you get compensation, and you're operating through an S corporation, you're expected to get reasonable compensation. So that's kind of the defeat of the no self-employment tax of the owners, the shareholders, the S corporation. You're supposed to be paying yourself reasonable compensation, and the balance that you receive via the K-1 is your share of the earnings above reasonable compensation as an owner of the business rather than an employee of the business. So you get paid a reasonable compensation, W-2, federal withholding, federal self-employment, Social Security, Medicare tax paid through your W-2, New Jersey income tax paid through your W-2 as reasonable compensation of the S corp, do S corp work, and then you receive a K-1 for the income that is deemed above reasonable compensation. Therefore, that's not subject to self-employment tax. Same thing as a partnership. There's no entity tax on the entity itself, because everything flows out to the shareholders via the K-1. The disadvantages of S corporation, LLCs, partnerships, they have tremendous flexibility of what you can do. The disadvantages of the S corporation is, first, there's certain shareholders who are not allowed. So if you're another corporation, you're not supposed to be a shareholder of an S corporation. The S corporation could lose its election. Non-resident aliens, so people living overseas, not U.S. citizens, resident aliens, cannot be shareholders of an S corporation. Non-grantor trust, basically trusts that don't flow through automatically to the creator of the trust. They can't be shareholders in an S corporation. There's exceptions to some of these rules, but in general, the type of shareholder is limited. Also, the number of shareholders can be limited for an S corporation. The other downside is there's supposed to be one class of stock, and essentially distributions are supposed to go out equally to all the shareholders. So there can't be unequal distributions. You can't get creative with how the income's allocated through the entity for an S corporation. So the type of shareholders, the allocation of income is the problematic structure for S corporations, and also the reasonable compensation. If you only have shareholders as your only employees, you still have to run payroll through ADP paychecks, and you're still paying for that, even though it's costing you money. You have no choice. You're supposed to be running compensation. While the partnership can just get a K-1, and you avoid that kind of a cost expense of running payroll. It's very somewhat similar to partnerships, same concept, tax basis. It's kind of calculated maybe a little bit differently, but essentially the same. Your contribution goes into it. Your income, increases your tax basis. Your distributions reduce your tax basis. Your losses reduce your tax basis. One concept for both partnerships and S corporations is your tax basis can't go below zero. So something might show up on a tax return as negative, but your basis can never go below zero. So you can't get, technically negative tax basis. Your basis can only go to zero. C corporations. C corporations are generally used by, a lot of times foreign entities are operating here, or entities, because they won't qualify for S corporations, and they kind of want to pay their taxes separately here and operate as a separate structure rather than as a branch or other type of entity here. Also, the big corporations, there's a limited number of shareholders. There's no limited number of shareholders. The type of shareholder, they have more flexible capital structure, management structures. So it's the bigger companies generally are operating as a C corporation. Downside of a C corporation, why they became very unpopular for small investors, for small businesses, there's a double tax. Now they've kind of tried to correct this double tax. Years ago, it was 35% tax. they've reduced it to 21%. And they've also, when you factor in the qualified dividends that it would distribute, which can be 15%, you kind of get to the marginal rate of a shareholder of a flow-through entity, whether a partnership or a disregarded entity, sole proprietorship, or an S corporation. You kind of get to that 37% is the top marginal rate. C corporation, 21% federal, and then also a 15 or 20% tax on the dividends that distributes qualified dividends. In general, if you're a smaller business, it probably doesn't make sense for you to be a C corporation. But as every rule, there's an exception to it. Unless you have the type of shareholders who can't operate as an S corporation, you probably would want to be an S corporation, or more flexibility in the type of shareholders or members would be an LLC or LLP. So those are probably the more flexible structures than a C corporation that most small businesses want to operate. But there's always an exception. There's something called 1202 qualified small business stock. Why is that interesting? Well, number one, the reduced rate of tax of 21% has made operating as a C corporation not necessarily as painful as before in terms of the earnings it's earning on a kind of yearly basis. Then there's 1202 business stock, where essentially your gain on that stock could be excluded for tax purposes. So you're talking $10 million of gain on the stock, you can exclude that gain. So that's very attractive. Before, years ago, it was 50% of the value of the stock, 75% of the gain, 50% of the gain on the stock, and then it went up to 75% during the great financial crisis, and then now it's up to 100%. So it kind of eliminates, get double tax for C corporation. You get taxed, it's not a flow-through entity. So C corporation pays income taxes, and the shareholder on its distributions pays income taxes. Unlike a sole proprietorship, where it's just the sole proprietor, schedule, everything gets reported in 1040. Partnership, flow-through entity, everything goes on to the 1040 via the K1. S corporation, you get W-2 compensation, which is an expense of the S corporation. And then for the excess, you get your K1, which gets reported on your 1040. There's no separate S corp tax for the most part. There's minimum taxes for an S corporation, also possibly a partnership, but you're paying your tax, most of your taxes at the 1040 level, essentially all. C corporation, there's two layers of tax: the dividend tax for the shareholder paid on their 1040, and the corporate tax, income tax. The advantage of that is this qualified small business stock exclusion, which could be millions of dollars. The downside of this, everything's got a downside, is as you'll see, except for professional services business, accountants, lawyers, they don't qualify. Banking, financial, farming, oil and gas, mining, hospitality, real estate, and other passive businesses. So they don't qualify. There's a size amount of the business. It's going to be a direct investment in the C corporation. You have to hold it for a certain period of time. So it is attractive for the right type of business that you might want to sell in the relative future. C corporation can be attractive because of that qualified small business stock exception, which may allow you to exclude millions of dollars in gains from the sale of the business as an original direct investor in the C corporation, and you have to hold it for a certain period of time. But that is the kind of the loophole why you might choose a C corporation over an S corporation or a other flow-through entity. Dissolution. So when you form the entity, you kind of also want to plan for the end of the entity. Dissolution, LLC, single member LLC, sole proprietorship, you're treating as owning the assets. Now, if you had certain depreciation on certain assets, or there's some recapture, 179 recapture, but essentially the assets are your assets, and therefore there's limited filings to dissolve. Final schedule 1040. You're going to just report on your usual tax return. You don't have to mark it final. There's no tax clearance. There might be an annual report fee, and you might have to withdraw from non-home states and home states, and very limited for LLC filing with New Jersey to kind of dissolve the entity. But since the assets are your assets, they flow out to you, get rid of the entity, essentially without too much problems. Liquidating partnership distribution. Now, this is the advantage of a partnership, is that you can decide, I don't want to be partners with someone anymore, and you distribute out the property to the owners of the partnership. You divide up the property. You're basically, essentially, for the most part, taking their tax, the partnership's tax basis in the property that flows out to the partners. Therefore, there isn't an immediate recognition of a gain or loss. When the partner sells that property, then the partner will pick up the gain or loss. So it's easy. It's easier to dissolve, not as easy as a sole proprietorship because you're not deemed the owner of the assets, but it's pretty close. Now, the partnerships have a lot of separate rules on liquidating and a lot of special rules on contributions and that type of thing. So this is very high, low level, the general rules that we're talking about. Just to get into a couple little things that we can talk about is when we're talking about tax basis, if the partner receives cash, marketable securities that are above his basis in the partnership that we talked about before, then he's recognizing a gain. He's recognizing generally a capital gain. If the partner gets everything back, there's no other assets, you receive no non-cash assets that he's holding on to, he can recognize a loss. If there's continuing distributions of the partnership or holding assets, he might be limited when he can take that loss. Then also there's something here, I just want to make people aware of this. Like I said, there's many different exceptions for partnerships. If you make a contribution to a partnership of appreciated property, and then it goes out to partners within 7 years, not the same partner, then there could be a gain that's picked up at a partner who contributed to the appreciated property. They don't want that partner to lose, to contribute appreciated property and then have it flow out to other partners who are in lower tax brackets, essentially. They want that partner contributed appreciated property who basically gave property with a tax liability attached that just hadn't been recognized at that point to lose out on taxing him. So that's just something to think about if you contribute appreciated property and then you kind of distribute it out or dissolve the entity. You know, sale of partnership interests, it can be capital gain. So you're selling the property. There's the entity theory where it's the capital gain. So you sell the partnership interest, you have capital gain. But the issue is there's certain assets that don't get that capital gain treatment. So there's 751, which is your own inventory, receivables, they're taxed as ordinary income. And then there's also depreciation recapture on certain assets that took depreciation. So it's not as clean as selling, say, a C corporation stock. You still might have to pick up ordinary income, but it is treated as an entity. Partnership's treated as an entity for the sale, and you can pick up capital gains. And what's going to determine if you pick up capital gains is that you're receiving more property than your tax basis. So the tax basis for partnerships as corporations is extremely important. Corporate dissolution. Now this is going to be a lot, a lot more involved, more formalities, more tax consequences. For corporations, there's a saying that's very easy to form a corporation or get into a corporation, not necessarily so easy to get out of it. So there's a federal form to file, you got to file a final return, then you also got to get New Jersey tax clearance. For most LLCs, you can just go online and dissolve. For New Jersey tax clearance, you have to go in and basically pay your taxes in advance to a large extent. And then they'll give you tax clearance, and then they'll tell you to file a final return within a certain time period, generally 30 days. So there's formalities. Now, if you owe back taxes, New Jersey is not going to give you tax clearance. If you haven't paid your annual reports, you might be revoked. Same thing for other LLCs. You might be revoked. And then you're going to have to reinstate before they're going to let you dissolve. And then you have to withdraw, dissolve in other states as well. So that's the thing. There's a lot more complications for corporations in dissolving than other types of entities. Now, corporations, one of the biggest issues with a corporation is if the corporation sells all its assets and distributes cash, then you're basically looking at basically a sale. It's considered a sale for the exchange of stock. So you're kind of getting cash back. The corporation itself liquidates all the assets. You paid for your stock 100 grand. Your basis in the stock's 100 grand. You're getting back assets of 85,000. You're taking a loss of $15,000 capital loss. If you get back $110,000, then you had a capital gain of $10,000. That's when the corporation liquidates all the assets. Now, the corporation is paying taxes on that liquidation. There's double tax here. So the corporation is paying taxes at the corporate level if there's a gain or loss on the sale of the assets. Now, the shareholder receives non-cash assets. Corporation is treated as selling distributed assets for fair market value to the shareholder. So therefore, the corporation is paying taxes, even if it distributes out the property to the shareholder. So unlike a partnership, which just for the most part can distribute out assets that have gain in them, and the shareholder, that gain isn't recognized until the partners decides to sell that property. For corporation, if it's distributed out assets, it's treated as a sale to the shareholder at fair market value. Why would that be a big problem? If you have real estate into the corporation. So you have real estate in a corporation, and you dissolve, I want to dissolve the entity, and there's a huge gain, increase in value because the corporation has held that real estate for years and years, that can be problematic. So that's why we generally say you want to hold real estate inside a partnership, an LLC, a flow-through entity where you can distribute that out, where you don't have to pick up the gain rather than a corporation. Also, corporation also subject to passive rules or certain things, but as corporations. But for the most part, you don't want to be hold real estate in corporations just for that reason. You want to hold the real estate in an LLC, LLP, disregarded entity, where you can distribute that out without tax consequences. Now you can dissolve the entity. You can choose to dissolve the entity. You have a plan, and you can do it over the course of more than 1 year. Why would that be important? Because you want to get capital gain treatment. Say if you have losses in the stock market of $1 million, you want to treat the gain on your corporate stock as a capital gain rather than a dividend. Why? Because a dividend doesn't get offset by your capital loss carry forwards, while capital gain through the stock of the corporation could be offset by your capital loss carry forwards. So that's very important. That could make sense to do. Really want to structure the closing of the business so it qualify for capital gain treatment. And why this is an issue when you have E&P. So you have accumulated E&P, accumulated the stock, the corporation has earned earnings but hasn't paid dividends. The owner didn't want to pay dividend tax. Now, there's restrictions how much accumulated earnings that a business can sometimes have without creating a taxable event. But we'll just assume that the business will allow to accumulate the earnings and profits, never distribute to the shareholder. If you dissolve the entity, you can get corporate capital gains treatment and avoid ever paying the dividend tax on the E&P as dividends. So it's just a matter of how you structure the dissolution of the corporation. Real estate, I think we just kind of talked about this already. Sole proprietorship, flow it out, no tax. Partnership generally can flow it out without any tax, even if it's appreciated. Corporation, you cannot do that. Corporation sale, redemption, this is just basic ways of ending the corporation. Corporation has multiple shareholders, they redeem your stock. You sell to a third party, you do an asset sale, or you can do a stock sale. For the most part, with your transactions on the smaller corporations, the buyer's going to want to do an asset sale. Why doesn't they want to do a stock sale? Number one, they want to allocate the purchase price to the inside assets of the business. And two, they don't want, which give them a step up for depreciation, bigger tax deduction. Two, they don't want to buy your problems. There could be product liabilities, contract disputes, all types of things going on. If you buy the stock, you're buying those problems. If you're buying the assets, you're not buying those problems. You're just buying the assets. Generally, the buyer is going to want to do it that way. The stock sale is going to be preferred by the seller, and this is the way larger companies are done. They're either going to be a merger or a sale. But for the smaller companies, most sellers are going to want to do a stock sale. But for the reasons I just said, in terms of liability, risk, the buyer is not going to do a stock sale. For the most part, I think probably 80% of the time or more, it's going to be a sale of the assets for smaller businesses, smaller S Corp, C corporations. The seller is going to want to do a stock sale. They avoid second layer tax. They're going to avoid they're going to get capital gains treatment on the entire proceeds if they do a stock sale. But the buyer is probably not going to go for that basically 80% of the time. The only reason they would generally do it if there's certain contracts that can't be transferred to a new entity. They have to be held by the current entity, and therefore it makes it problematic to transfer certain assets, patents or other type property to contracts with the government to a new entity. There's also, just to be aware, certain S corporations and other corporations, there's an election. You can treat it as a stock sale for certain purposes and then also an asset sale. So it's always something that you want to consider. But I don't want to go into too much detail because we kind of get into a little bit higher level discussion, but it's good to know that on certain S corporations or consolidated group member, there might be an option to make an election to treat as a stock sale as well as a asset sale. Now, transferring, generally, it's not going to be too much. You might have to get a new tax ID number, but you transfer assets from a sole proprietorship into a partnership, not a major problem for the most part. If you go from a partnership, you buy out your partner, and you become a disregarded entity. You might have to change the tax ID number, or payroll, certain other things, but for the most part, it's not going to be a huge problem. If you go from a C corporation to an S corporation, that means you never pay tax on the earnings and profits of the business that weren't distributed as dividends. So therefore, there's kind of you're going from double tax to single tax. So therefore, the IRS puts in special rules to be aware of, and it's more problematic to do. Number one, you got the earnings and profits. Then also you have appreciated assets that the C corporation was never taxed on. Therefore, the IRS builds in a built-in gains tax, and also the E&P eventually has to come out of the S corporation. So just things keep in mind. Going from a C corporation to S corporation is possible, but it takes definitely some planning and definitely some planning during the operation of the entity. If you have a built-in gains tax, the built-in gains tax disappears after a certain period of time. So therefore, you might want to hold those assets until the built-in gains tax disappears from the former C corporation now operating as an S corporation. Real quick, as we're kind of getting to the end of the time frame, New Jersey has a little special rules. We talked about one, no entity level tax. New Jersey has created the opportunity, as most states have, of creating an entity level tax for state purposes, where the partnership or S corporation, not sole proprietorship, but partnership or S corporation, pays tax, business entity tax from New Jersey, get a federal deduction for it, and then a credit on the individual's tax return, which would come out in the New Jersey K-1. What's the reason for that? It's going to reduce your federal taxable income. It's not a deduction for New Jersey, but it's a deduction for federal taxable income, and you get a dollar for dollar credit in New Jersey. The advantage, you're going to pay less federal taxes. It's an additional filing you have to do when you're paying taxes. You have to make estimated payments at the partnership level or S corporation level. but it's going to save you federal tax. So if you're making significant money through your flow-through entity, then it makes sense. Sole proprietorship, not allowed. So we've seen some people, and sometimes it makes sense, is that you might have 99% one owner and 1% another owner. So you go from a sole proprietorship of 100%, create a partnership. Now you have two people, not just one. So now it's a partnership, and now it's got to do 1065 filing. They issue K1s rather than directly report on a tax return. But you qualify for the New Jersey BATE tax, New Jersey Business Alternative Tax. So you get that federal deduction for the BATE tax that paid. Now, most people know SALT limitation, your state and local taxes, real estate taxes are limited to $10,000 now since 2017 tax reform. So you lose the New Jersey tax that you paid for the most part, whether it's real estate taxes or income taxes, you're very limited in your deduction. But business is not limited to deduction. So therefore, you can take the full amount of New Jersey taxes on the business tax return. New Jersey buckets. New Jersey, if you're a partnership, you can only offset partnership income with partnership losses. Otherwise, it's zero. For S corporation, only S corporation income versus S corporation losses, or rental activity versus rental activity. They have to offset their categories of income for New Jersey, and you can't go below zero. Now, New Jersey, that's why you want to think about how you structure your business. So if you have S corporation, has huge income, maybe it makes sense to be an S corporation for something else that's going to have losses, at least for a time period, because they're going to be allowed to offset each other dollar for dollar. If you have it set up as a partnership, you're not going to get dollar for dollar offsetting. One S corporation making money, partnership losing money, they're not going to offset dollar for dollar. Jersey's tried to work on this little area for the last few years, and it's created New Jersey alternative business tax, but it's kind of still limited to 50% of the actual loss. So you don't get dollar for dollar. There's an alternative calculation. If you have net business income of one class, you can take a deduction from another class against it, basically 50%, and there's a carryover of the unused amounts. So New Jersey's kind of trying to limit the buckets, but they still have them. And even though you can get a New Jersey alternative business deduction, you're kind of losing some of that loss to some extent. The other real quick thing to think about, you form in New Jersey, you operate in another state, you got to get authorization to operate in that other state to recognize the entity. And also you're going to have to withdraw from that. So say you form in New Jersey and you're operating in Massachusetts, then you're going to have to get authorization to work for the business in Massachusetts. They want a little fee, of course, and they're probably going to be looking for a tax return. If you no longer have operations in Massachusetts, then you're going to have to withdraw from Massachusetts. But that's the other thing, that most type of entities, you're going to have to get authorization to do business in those entities. It's particularly important, say, if you're an S corporation and they don't recognize the S corporation automatically, you want to really watch that. You don't want them to treat you as an S corporation for federal in New Jersey, while C corporation somewhere else. And that pretty much covers it for my presentation. Hopefully, you learned a little bit, and hopefully you kind of got a better idea of what type of entity you want to be in the future. As Katie said, put your questions in the chat, and we'll kind of answer those directly to everybody, after the presentation. Thank you. Katie?
Thank you, Glenn. Thank you. That was fantastic. And we appreciate you sharing all that information with us. Like you said, I think it's a topic a lot of people could use more information on. So that was great. And hopefully, yes, everyone found it valuable. Like Glenn said, if you guys have any questions, you could submit them in the Q&A. We didn't get any, but also if you have Glenn's information or mine, feel free to reach out. I'll also put my email in the chat, just so if you want to reach out to us directly with a question, you can do that.
And also, if you also want the PowerPoint, just reach out to Katie or myself, and we'll send you a copy of the PowerPoint. Perfect.
Yep. And I just want to mention before we close out, there will be a survey for feedback that'll open in your browser when the webinar ends. So if you could leave your thoughts, if you have any questions, you want to submit them there. Again, Glenn and I will find a way to put you in touch with the right people or answer your questions. And we'd also love to hear future topics that you'd be interested in learning about. Glenn's one of our good presenters. So if there's anything, any of his expertise, something else you'd like to discuss, it's our goal to appeal to you and your interests. So if there's nothing else, we can go ahead and wrap up. Thank you again, Glenn, for sharing all the information with us this afternoon. I think this is great. And thank you to all of you on the call for taking time out of your day.
Thank you, everyone.
Thanks. Have a good rest of your day.